Hey everyone, welcome back to Corporate Decoder. Today, Crescent Capital BDC Incorporated ticker C.C.A.P just filed an 8K, and I see a critical update on their bond offerings. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is reminding everyone about their bonds due in 2026. And it is a good time to check in on companies with upcoming debt maturities. Alright, so digging into this filing, Crescent Capital BDC Incorporated is essentially reminding the market about their specific bonds that are due in 2026. These are their 5.00% notes, and the filing confirms they are still outstanding and due for repayment. Now, why is this important? When a company has debt coming due, like these notes that are listed on the New York Stock Exchange, investors and the company itself need to be thinking about how that debt will be handled. Will they refinance it, meaning take out new debt to pay off the old debt, or will they simply pay it back with cash? We're seeing this filing on May 13, 2026. Which is pretty close to the maturity date itself. This kind of filing, often called a current report, is used to announce significant events. In this case, it seems to be a confirmation and a reminder about their existing debt obligations. Think about it like this. If you have a big loan payment due in a few months, you start planning for it now. Companies do the same thing. And public filings like this are part of that communication process. Crescent Capital BDC Incorporated, or C.C.A.P as it is traded on NASDAQ, is a business development company. These types of companies typically invest in small and medium-sized businesses, often providing debt financing. So they are essentially lenders themselves, and they also rely on their own financing, like these bonds, to fund their operations. With a 5.00% interest rate on these notes, it tells us about the cost of borrowing for Crescent Capital. This rate is important because it impacts their profitability. If they are lending money out at rates higher than 5.00%, they make money. If rates are lower, or if other expenses eat into their returns, their profit can be squeezed. Looking at the broader picture for C.C.A.P, the PE ratio is around 177.0, which is quite high. This often suggests that investors expect significant future earnings growth. However, it can also indicate that a stock is overvalued. High PE ratios, especially for companies involved in lending or financing, can make them more sensitive to any hiccups in their business. We've also seen some headlines recently discussing their bonds and earnings. For instance, a headline from April mentioned the FCRX bond holding the $25 level. FCRX is actually the trading symbol for their 5.00% notes due 2026. The very same notes we are talking about. That headline suggests the market is watching the price of these bonds, which is common as maturity approaches. Another headline mentioned that their fourth quarter of 2025 earnings topped views, which is generally positive news indicating the company might be performing better than analysts expected in that period. So, this filing about the notes due 2026 isn't announcing a new problem, but it is a reminder that the company is actively managing its debt. It prompts us to consider how well they are positioned to handle these upcoming obligations. The key takeaway here is that companies need to manage their debt effectively, and upcoming maturities like these notes are a critical part of that financial health. For Crescent Capital BDC Inc., the current filing serves as a public record and a signal that these 2026 notes remain a significant item on their financial radar. We are approaching the maturity date for these notes, and it will be interesting to see how the company decides to manage this debt. Will they fully pay it off, or will they look to refinance it? This will depend on their cash flow, their ability to borrow more, and the overall economic environment at the time. What I'm actually looking for is how they manage this approaching maturity without it negatively impacting their ability to do business or their stock price. Alright? That is my take. Stay decoded. If you found this analysis helpful, please like and subscribe, and check the description for our Discord.